Hook and Promise. Hey there, welcome back to the Capital Breakdown. Today we're tackling a question that trips up a lot of investors. Are you really investing in the whole US stock market, or just the biggest, most famous companies? It sounds simple, but the difference between a total market index and the well-known S&P 500 can change how diversified your portfolio truly is. By the end of this episode, you'll understand exactly what sets these two index types apart, how they work behind the scenes, and why that matters for your investing journey. Whether you're just starting out or looking to refine your approach, this breakdown will help you see the bigger picture of US stock investing. The problem or confusion: most people think that buying an S&P 500 fund means they're covered when it comes to the US stock market. After all, it tracks 500 companies, right? But here's the catch. Those 500 companies are the largest players by market value, which means the fund is heavily weighted toward a handful of giant firms. Imagine you wanted a fruit basket representing all the fruits in a market, but your basket ended up mostly apples and a few oranges. Other fruits like berries, melons, and peaches barely make the cut. That's a bit like what happens when you focus solely on the S&P 500. Many everyday investors don't realize this, and it can lead to less diversification than they expect. Core concept explained. Let's break this down simply. Think of the US stock market as a giant orchard with thousands of trees, big, medium, and small. A total market index is like picking fruit from every tree in the orchard. You get a scoop from the enormous trees, sure, but also from the medium and smaller ones. The S&P 500, on the other hand, is like only picking from the 500 tallest trees. Both are baskets of fruit, but one is broader and more varied. This difference matters because the total market index includes small and mid-sized companies that the S&P 500 leaves out. In terms of investing, that means more companies, sectors, and styles are represented, which can affect growth potential and risk. Core concept explained, continued. When we say market capitalization, that's just a fancy way of saying the total value of a company's shares. The bigger the company's market cap, the bigger slice it takes up in the index. In the S&P 500, the biggest tech giants or consumer brands dominate the pie chart, making up a huge portion of the index's value. Total market indexes still weight by market cap, but because they include thousands of companies, the big ones don't crowd out the smaller ones as much. This means your investment is spread across a wider set of businesses, which can help smooth out the bumps along the way. How it actually works behind the scenes: index funds or ETFs that track these indexes rely on fund managers or algorithms to hold shares of all the companies in their benchmark. When you put money into a total market fund, it's pooled together with other investors' money and used to buy shares from every company in that index, weighted by size. Brokers help facilitate these trades, and regulators ensure the market operates fairly. Fees come into play here too. These funds charge expense ratios, which cover management and operational costs. While these fees are usually low for index funds, they do slightly reduce your returns over time. Money flows in and out daily as investors buy and sell shares, causing the fund to rebalance to maintain the right proportions. How it actually works, continued. It's also worth noting that the S&P 500 is curated by a committee, which decides which companies make the cut based on size, liquidity, and sector representation. The total market index, by contrast, is more mechanical, often including nearly every publicly traded US company above a certain size threshold. This means the total market index can capture up-and-coming companies before they become giants, whereas the S&P 500 tends to feature more established players. Both indexes reflect different philosophies. One focuses on large, stable companies, while the other aims to capture the full breadth of the market. Simple, concrete examples: imagine two friends, Sam and Jamie, both invest $200 a month in the stock market. Sam chooses a broad total market fund, so his money buys tiny slices of thousands of companies, from big players to small innovators. Over time, Sam is exposed to a wide range of industries and company sizes, which can help reduce risk if one sector stumbles. Jamie goes with a broad S&P 500 fund, focusing on the biggest 500 firms. Jamie's investment is more concentrated in mega companies, so if those giants do well, Jamie benefits. But if a few big names falter, the impact could be bigger. Both approaches involve risk and reward, but the experience and exposure differ. Simple, concrete examples continued. Now, consider the emotional ride. Sam might feel steadier seeing less dramatic swings because his portfolio is spread out. Jamie might experience more volatility tied to the performance of the largest companies. Both should expect ups and downs because stock investing naturally involves market fluctuations. Neither approach guarantees smooth gains or avoids losses. The key takeaway: how much diversification you want and how you react to market swings can guide your choice between these index types. Remember, it's not about picking the best fund, but understanding what you're getting. Risks, traps, and common mistakes here's where many investors stumble. First, putting all your money into a single stock or just a handful of large companies increases risk dramatically. If that company struggles, your portfolio takes a hit. Even with index funds, concentration risk exists, especially in the S&P 500, where a few mega-cap stocks can dominate returns. Another trap is chasing short-term performance or trying to time the market, which almost always backfires. Volatility can feel scary, but patience and a long-term horizon help smooth the journey. Avoid leverage or margin unless you fully understand the risks, as these can amplify losses just as easily as gains. Risks, traps, and common mistakes continued. Also, don't assume more companies always mean better results. While total market funds add diversification, they can include smaller companies that are more volatile or riskier. It's about balance and what fits your goals and risk tolerance. Many investors overlook fees, too. High costs can quietly erode your returns over decades. Finally, beware of letting excitement or fear drive decisions. Sticking to a consistent plan and regularly reviewing your holdings keeps you grounded. The capital breakdown always encourages you to understand the risks and keep realistic expectations about growth and setbacks. How to think about this tool when you zoom out: index funds, whether total market or S&P 500, are just one piece of your financial puzzle. Before investing, make sure you have a solid emergency fund and a clear budget. Think about your time horizon. Are you saving for retirement 20 or 30 years away, or a shorter-term goal? Your choice between these indexes might depend on your comfort with risk and desire for diversification. Both can play a role in a well-rounded portfolio. Remember, investing is a long game, and building wealth steadily over time beats chasing quick wins. Keep your financial goals front and center, and use these tools to support your plan. How to think about this tool continued. It's also important to revisit your strategy periodically. Markets change, companies grow or shrink, and your personal situation evolves. The capital breakdown encourages you to stay curious and informed, but also disciplined. Diversification is about managing risk, not eliminating it. And while total market funds offer broader exposure, the S&P 500 can provide focused access to some of America's largest and most established companies. Both have merits, and understanding their differences empowers you to make choices aligned with your financial life, not just trends or popular opinions. Recap and educational disclaimer. All right, to wrap up today's episode on the capital breakdown, first, know that the total market index covers a wide range of U.S. companies, from giants to small caps, while the S&P 500 focuses on the largest 500 by market value. Second, this difference affects diversification and risk exposure, so it's not just about the number of companies, but their size and weighting. Third, investing always involves risks, and patience with a long-term mindset is key. Remember, this video is for educational purposes only. It's important to do your own research and consider speaking with a qualified financial professional before making any investment decisions. Thanks for tuning in, and here's to building your financial confidence one step at a time. Thanks for watching the Capital Breakdown. Remember, this is education, not personal investment advice.